Good evening, everyone, and thank you very much for joining us tonight. Tonight we're joined by Karl Bauer from Bauer & Co, and I've invited Karl to speak to us because I guess everything's changed about 3 or 4 weeks ago, and we've all been scrambling around, well, most of us have been scrambling around to readjust to these changes that have been caused by the coronavirus. And it's triggered off a number of different things. And I know that in my own personal situation, I really realised things were getting real about 3 weeks ago. And at that point in time, the market had already sold off. We were aware of what was going on. We did expect it to go down, but we did not expect to see the market move as quickly as it moved. We weren't surprised to see it move down, but I don't think anyone thought that we were going to give up 38% in a 4-week period. Even if it was the start of something like the GFC, I mean, the GFC did that in 47 weeks. So, more than 10 times faster on the move down. It really just dropped away from under our feet. And then all of a sudden we were looking at the fact that we were going into isolation and lockdown. Businesses were being shut down. We were looking at our own business thinking, well, what will be the impact be on ourselves? The next thing is, business owners start thinking about how well their businesses are financed. So we need to go and speak to experts about the different scenarios there. And I know as someone that's got a mortgage and a young family, the next thing I'm thinking about is, well, if my cash flow starts to dry up, how am I going to manage my home loan? How am I going to pay interest? All of these things are happening to all of us, right? To different extents, but they're all things that we've got a heightened awareness of. And I thought it'd be good to get Karl in because Karl was one of the first people that I called to ask him questions about my own personal circumstances around my home loan, about business loans and the like. And Karl is a very experienced finance professional, and he has experience beyond simple, that leads him into more complex business lending and the like, but has got all of the everyday knowledge that you would need to have and can advise just on the details. So I thought it'd be good to get Karl in to run through where we're at the moment, but also to provide us with some more information about what's going on out there and to answer the questions that we've got. Now, I'll go through the normal housekeeping stuff. So if you want to ask a question, please do at any point in time. You should have a chat box open on your screen. Not everyone else can see the chat that you put in there, so don't worry. We won't share your full name. We'll simply call out your first name and read your question to Karl. You can ask any question you want, and I'll read it out to Karl, and he'll do his best to answer it. So I'm just going to click through and go through the disclaimers. So if there is any advice provided tonight, it's going to be general only. It's not going to take into consideration your circumstances, and you need to decide for yourself whether it's appropriate for you. Past returns are not an accurate indicator of future returns. All right. So this is Karl. All right. Karl, welcome.
Hello, Patrick.
Thank you very much for taking the time, mate. It's much appreciated.
Pleasure.
How did you want to run this session tonight? Do you want to run us through your thoughts on what's just happened?
Absolutely, yeah. So look, this is on the back of an article that I wrote and you published in your newsletter. And at the point of time that I wrote it, you and I both felt that the media was a little bit asleep at the wheel with regards to what was going on, and there was no real practical how-to plan or discussion on what actual deferral of loan repayments meant at that point in time. So it was really kind of an important time to get on the front foot and start speaking to clients and even friends who own businesses and really get in front of people and help them as much as we can, and just to guide them through the avalanche of information that's come out and continues to come out, Patrick. So yeah, I'm happy just to. I was just going to spend.
What happened with the banks? So, because I know that the first thing I did, and I called you right at the start, going, mate, this is going to get really bad, and we're like, as a trader looking at the market and just seeing what was happening, we could just see it was in free fall, and the fear levels were through the roof. Volatility was going nuts. So I think I was probably a little bit ahead of the pack when it came to getting in and trying to organise conversations with the banks. But my feeling was that they were just completely shell-shocked.
Yeah, I think that's probably an accurate perception. Look, they've been proactive, and they've certainly been on the front foot, and they've stayed in front of it, just along with the government, which has been quite pleasing to see. But everyone is, I used the word scrambling earlier. Everyone is scrambling, including the banks. So yeah, look, they have put some offers into the market, some relief packages into the market, and they're changing as recently as today, particularly for commercial borrowers. They've increased the threshold for business loan facilities to be allowed to access the relief packages that they've got in place. So look, yeah, look, they're in a position where they don't want people to fail. It's obviously not a commercially smart way to run your business if their clients are failing. So they need to be in front of this, and they need to be helping people through these unprecedented times.
When we were in the GFC, I remember that there was an extraordinary amount of people in certain suburbs around Melbourne that were in default on their home loans. Like it was a shocking number, and it wasn't being reported in the press. And the banks were managing it directly with these people. And I think, compare that to what happened, say, early 90s, where it was a kind of a prisoner's dilemma kind of scenario with the banks all competing against each other to offload the property risk they had on their books. What are they putting forward now? Like, what are your options with home loans if you're in distress, or you're worried, you think you're in hardship, or your earnings have gone down? What can you do?
Yeah, look, it's important probably just to clear up one misconception, because I have been getting asked the question about when banks are starting to defer payments, as though it's going to be an automatic freeze of mortgage repayments or business loan repayments. That's not actually the case. So they'll certainly treat it on a case-by-case basis. And the main relief package they've got in place at all lenders is they will allow you 3 to 6 months deferred loan repayments, which comes with some very important, I guess, catches, if you like. So you need to be aware that the interest will capitalise during that period, and you need to be aware of what will happen at the end of that deferral period. And banks are treating that a little differently. So some are extending the loan term by a further 6 months to smooth out the repayments. Some are allowing repayments to be made intermittently throughout that deferral period. So yeah, it's really important to understand exactly what you're agreeing to before you go into it.
So Karl, is the main sort of situation that if they do agree to defer, because my understanding is they're saying if you meet their hardship requirements, then you may be eligible for a 3-month deferral, which if those are still the case, another 3 months after that, and that's all they've kind of said so far. Do they just add your interest on top of your loan? Is it as simple as that, or is there any other penalties that you might need to be aware of?
No, it is as simple as that at the moment. So it is just purely a capitalising interest period or compounding interest period. So if you can, I'm sort of advising clients at the moment that if you can afford to meet some level of repayment during that deferral period, it's going to put you in a far better position. So it might even just be intermittent repayments, just to try and get that compounded interest bill down at the end of it, because that can really add up on a large mortgage.
Yeah. So we come at it. I mean, obviously I'm in the finance game, but we don't deal with banks, and so I can say this, but you might not be comfortable with it. If you're going to go in and to see the bank, and you've got a whole bunch of money sitting in your offset account with that bank, and you want to go on a hardship sort of scenario, they're not going to look that. They're going to probably, there's a good chance they'll say, no, you've got enough money, you're fine. Come back to us when you've got none. So you might want to think about cleaning those accounts up a little bit before running in and seeing the bank on that basis, I would have thought. I don't know if you can say anything about that, Karl. Leave it.
I'm glad you said that and I didn't. Most definitely,
Yeah.
and the same applies to a redraw facility as well. So if your money's sitting
Hopefully
actually on the loan,
hopefully my bankers aren't on this call. No.
I don't think they would be at the moment. Yeah.
Yeah. All right. So in your what do you think the best scenario is? Defer interest only. Is there another scenario?
Look, if you can afford to make interest-only payments, that is the best scenario. I feel if you are in difficulty and you find that you need to make arrangements, you can afford to pay interest only, then that's great. Just keep in mind that if you have an owner-occupied home loan, the lenders don't make it very easy to switch to interest only. You have to have a strategy behind it, so it may be a long-term tax strategy if that property was going to become an investment down the track or whatever it might be, and that would generally have to be signed off by an accountant, some sort of evidence around that. So
In my situation, I wanted to go. I called up the bank and said I want to go on interest only, and they called me back and asked me, and I abided by the rules that I mentioned and made sure that there was nothing in there. And put forward, I run a business and I, obviously employ 20 people and I want to make sure everyone keeps their jobs. And immediately when this all went down, I cut my wage and did things like that just to be conservative. And one of the steps in this process was to remove the principal payments on my home loan. And the feedback from the bank was that it is much easier to go and get a deferral than it would be to go on interest only.
That would be absolutely correct. And it's not the bank's being nasty, so to speak. This is on the back of a few years of regulatory change and the Royal Commission, etc., and I guess responsible lending. So the regulators, being APRA mainly, don't want to see owner-occupied borrowers on interest-only debt. So they have made it very difficult. But
surely they should be switching at this point in time. I mean,
if it makes ever a time,
wouldn't they be rather people be paying interest only than going on deferral plans? I mean, it just sounds that
it's the next guidance. The government regulators, they've worked well to date in conjunction with state and federal government and the banks and the industry players and unions even to proactively state that this deferral period won't be treated as arrears, so it shouldn't impact credit scores. But the next stage of guidance that I'm seeking is something to make, something like exactly what we're talking about, something to make it easy for owner-occupied borrowers just to switch to interest only for a period of time. 5 years ago, you could be a CBA customer and jump on your NetBank app on your phone and click a button and you'd have a 5-year interest-only period regardless of whether or not you were living in it or if it was an investment property. So whilst I don't advocate for that level of flexibility, I think that there should be some sort of grace, I guess, given these times to the lenders, because they're the ones that are under the microscope, obviously, and rightly so. There needs to be something that takes the liability away from them, just to allow borrowers to switch to interest only for at least a year or two. And you're right, everyone wins in that case, because the banks need cash flow, obviously, so they're getting their interest payments up front. The customer isn't racking up a huge compounded interest bill, and hopefully there's light at the end of the tunnel, and 12 months is better than 6 months from a cash flow sort of smoothing out perspective.
Yeah. So if you make, say you're looking at any of those scenarios at the moment, good luck getting onto one of the banks. One of them was querying a transaction done on a new account. I'd started to send some money over to America for something, and they contacted me to verify, something. And I tried calling them back twice and was sitting there on hold for half an hour. I don't know what they did. The transaction went through, but just waved it through.
Massive call volumes in the banks at the minute.
Any tricks around getting to the front of the queue, calling at the right time, dealing with the right people, groveling?
I wish. Look, I'm sure there's there's possibly some business bankers or private bankers in some of these lenders that have access to certain departments that'll allow things to move through quicker, but on the whole, when it comes to hardship provisions, which is essentially what we're talking about, it is a case by case, and they have to go through a pretty detailed process. Now, unfortunately, most of the banks are getting absolutely hammered with in terms of call volume at the moment. So a lot of them do have special pages set up on their websites and actual online forms that you can complete to go through the process. And they will obviously come back to you, but that's a far better I'm hearing 2 to 3 hour wait times on hold, that sort of stuff going on at the moment for some of the big banks. So just be careful.
Yeah. I went and saw the banks. I have to say, as far as social distance going, that tiny little office I spent an hour and a half with my bank manager was very, very questionable. But one of the things I asked him about was the loans, the unsecured loans that Scott Morrison had just announced. I heard that. I was in there. That seemed like shit. They're quick smart. But yeah, that still, they sort of got back to me, and nothing has come of that conversation. I probably have to get someone in my office to sit on hold for a couple of hours and try and get through to have that conversation again. But can you talk us through those unsecured business loans and tell us what are the banks saying about it now?
Sure. So the government has agreed to guarantee up to 50% of unsecured lending for a max term of 3 years, maximum loan amount of $250,000. So whilst they have kind of announced that, it's now up to the banks to implement it. And if you think about the banks like the Titanic, in terms of being able to turn and move through processes, systems and technology in particular, it's not as easy as just agreeing to offer it. They have to build the mechanisms in the background to actually deliver it, and that is taking a little bit of time. That's one part of the process. The other I guess piece to the whole unsecured lending is the appetite for the banks. So in the past they have steered pretty well clear of unsecured business lending unless you're a very well established business with a huge turnover, or you're just borrowing a small amount, say less than 50,000 as say the small overdraft at 15% or whatever you're paying. So it's not as easy as just saying that we're going to provide a 50% guarantee on a $250K loan. It's actually qualifying for it, and as I said, the bank's appetite for it. So it'll be interesting to see how that plays out, but it's even yet to be properly delivered as across most of the lenders.
So the feedback I got on it was that a couple of things. One is that if you have numerous businesses, they will look at lending it for it. They'll look at it, but CommBank, who I do my business banking with, it was who I spoke to. They got back to me straight away and said, actually, I'll just share the first bit, which was the loan had to be given on the basis of hardship. Think about how strange that concept is. So you have to go in there with your pockets hanging out and to qualify, and which is not how banks loan. So it seems that will come out of that. But the other thing is that they said that they would have they were looking at a pretty simple process if it was a smaller amount, like 100K, and they would sort of try and look at doing that. But if you were going to go 250, then there'd be a whole bunch of hoops to jump through. And I think that my banker was just sort of, politely saying was, you might get a little bit out of us, but not too much.
Yeah. Yep. Code. So, yes. I think he's right. Yeah.
Yeah. What else is being talked about out there in finance broking land?
Yeah. Look, the lenders are they're still open for business. I guess it's important to note. So whilst the economy and I guess the general public is going through a pretty tough time, the banks are still looking to lend. So they've got, the books are open. They've been rapidly decreasing rates in line with the RBA, but also in response to this pandemic. So it's important to note that they're still around. They're still looking to attract business, and with that comes some pretty attractive interest rates in the market, and also some attractive cashback offers and things like that. So so it's important just to review what you're doing and where your loan sits in the market, and if you've got one at the moment, and just make sure that you're market testing that.
Karl, Hader asked a question on lending guarantee. Do you see any issue in a year or two with borrowing from individual businesses and governments with defaults, or another credit crisis arising from this?
Potentially. It's pretty early to tell. There's a lot to play out around the world, and particularly in our banking system. I've got a fear that our kids will be paying this off, Patrick.
Yeah. I think there's a couple of things that are a bit of a worry. It was very, very difficult. We're in the business of coordinating lending of money to businesses, but we don't specialise in dealing with banks, or we don't deal with banks. So it's vastly different. So it's more working with private investors or professional investors or small institutional investors mainly to provide capital. So it's been tough. I mean, even if you're wanting to borrow money into your business, you've got to basically give them your house, right? So it's I just can't imagine, where does this flow on from here, and how much more difficult is it going to be? And what is going to be the impediment on our our economy as a result of that? That's not getting to the credit crisis that you might be referring to, but I'm just saying that just on a smaller level. I just think it's going to be tougher for businesses, not easier. And I don't know whether government's got more of a role to play than they have been playing. They've made it pretty easy for the banks to build these humongous businesses, and we've done it in a way, I guess, where we got through the GFC with stable banking system, and they haven't necessarily behaved themselves that well in every instance since then, a la the Royal Commission. But I don't know what the flow on from this is. It's to be seen. I'm very concerned about our economy and the impact of what's going on at the moment will have. I don't, from a market view perspective, which is something that is probably not that relevant in this forum, but our view is a grind lower from here, not another fall off the side of the planet. We kind of already have been able to assess how bad this is, and it's bad, and that's why the market's come off 30 plus, but up to 38%, and it's not going back up. Well, it hasn't yet, and I don't think it will. It might have a short squeeze, but I don't know. We think it's more of a grind sideways and then down into reporting season. So thank you for the question, and I hope we've somewhat answered it. If there's any other questions for Karl around your circumstances that you'd like to ask, please put them into the chat box. What else you got for us, Karl?
I'll just add to you did sort of allude to what it might look like down the track, and I guess using the GFC as the parallel event. What we're starting to see even now is some lenders really tighten up on specific industry types and specific income types, so casual employees and some sole traders and so forth. I think we will start to see some big change, I think, down the track. It's going to be interesting. You might even see LVRs being trimmed back a little bit in terms of how much they'll lend in certain locations. It'll be interesting to see how they'll.
We haven't seen the LVRs being adjusted and then people having to refinance off the back of that, or provide or sell off the back of those changes, have we? Have we seen that? Did that happen in the GFC?
No, not really. No, there's certainly some in terms of recent regulation changes, even post GFC, but in the last couple of years, where clients have been effectively trapped in P&I mortgages coming off interest-only terms and banks not renewing it based on guidelines. So that has forced some real strain in the market, and definitely I'm sure there was some forced sales as a result of that, effectively mortgage prisoners. But yeah, I wouldn't have thought there'd be too many being forced to sell off the back of LVR changes.
What happens to, for a lot of us who've got investment properties, what happens if your tenant can't pay, you've got a mortgage to service? What happens in these, because we're being, obviously we don't want to put people out in the streets, and that's what the directive is from the government. And I guess you've got the other scenario, which is commercial as well. What happens? Can you just talk us through how the banks are handling that, and anything you know about the government policy around that?
Sure. So it's so the banks, in terms of what the banks are doing, it's still the same hardship provisions apply. So you still go through the same process, even if it's an investment property, regardless of if your tenant has stopped paying, and obviously you are not allowed to evict in the 6 month period. You can definitely apply for the hardship provisions, and the government, I think, a couple of days ago announced in conjunction with the banking association around commercial lending and commercial landlords who would be treated more favourably in terms of the threshold going from 3 mil in lending facilities to 10 mil in lending facilities, being eligible for interest deferrals and capitalisation and so forth, if they agreed not to evict their commercial tenants. So it's kind of evolving on a daily basis, it feels like, but certainly they were slow to move, I'd say, for both residential and commercial landlords in terms of any kind of announcements. It felt like that was left till last, but there seems to be some movement in that space now.
Another question from Hader. Thank you for your questions, Hader. But he's talking, I might paraphrase it a little bit, but our home equity credit is used to invest in the stock market, and also further drawn upon and used to leverage into other properties, right? And if this tightens right up, I mean, there's obviously a flow-on effect. Do you expect there to be a flow-on effect from this, Karl?
Oh, I certainly do. Absolutely. I think it's very early days, particularly in the property market. Even from a valuation perspective, we've just received the March quarter results, and Melbourne and Sydney in particular are up again. Not as much as the December quarter, but obviously this next quarter is going to tell the tale from price perspective. But it has to, the restrictions on lending, as I mentioned, there's 4 industries right now that are almost untouchable in terms of lending. The income types will start to tighten up as well. That has to have an impact. What it is, I don't know, but it certainly will have an impact, and hence the Batten down the hatches article that I wrote for you, Pat.
Yeah. Nick's asked, is it a good time to buy property and invest?
Look, I think property has to be considered a long-term investment strategy, regardless of when you buy. It's certainly an interesting time. I've certainly got clients who are right in the market and looking for opportunities and are actually pressing the button. But for my highly geared clients, obviously for a first home buyer or someone who might only have a 5% deposit, for example, I'm encouraging them just to sit tight just for a little bit to see how it all plays out. But as an investor, there could be some opportunities out there, but it's all about the vendors and who's going to be listing in this market. So, but you could see some distressed sales.
But what has property done recently?
So Sydney was up 3.9% for the March quarter. Melbourne was up 2.9% for the March quarter, and that was on the back of sort of 6 and 7% in December. So,
But you won't,
huge growth.
you haven't been able to run auctions for the
Yeah,
last,
correct.
I
Last
asked,
week.
but,
Yep.
well, yeah, for last week, but even before then, I remember, a few weekends ago, 3 weekends ago, talking to someone, an analyst I know had called me on the weekend and was saying, I don't care what anyone's saying and what they're reporting in the press. I've spoken to 3 real estate agents and none of them have seen a person at an open for inspection.
Yeah.
Yeah. At that point in time, the people like, industry experts, inverted commas, were saying, property prices stay strong and blah, 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 but realistically, we had a strong Jan, Feb, and then you didn't have any trade. We've got no data in March. People would have just not sold, in an immediate scenarios. They wouldn't have, traded down. You don't get the volatility you get with, say, the stock market. Because people just... So I think to get a feel for what property is doing, you're probably going to have to wait for another, for some time. Interesting enough, though, I was watching on the weekend, they're doing online auctions now, which is interesting. What do you do? Buy the house sight unseen. Yeah, but I get that's pretty specific. But yeah.
Well, there's still agents are still showing people through properties, but it's just one. It's a booked appointment, and blue rubber gloves are being used basically. So that's everyone has to go through and do the disinfectant and apply the social distancing rules and not touch anything effectively. But you're still able to go through and see a property. The live auctions are definitely not taking place. A lot more private sales are happening off market. So I mean, according to the agents that I speak to, so there's still activity in the market. It's just like you say, it's going to take time to really see the numbers to see how it all filters out. And that's what I was saying. It's kind of too early to tell what impact this is all going to have and where it's all going to impact in the economy.
Okay, Jay's asked, I hope I'm pronouncing that properly. My wife has been, hi Karl, my wife has been stood down from her job for a minimum of 3 months, but I'm still going with my work. Can I apply for deferment? I bank with CBA.
Sorry to hear that, Jay. Definitely you can. It's, as I said, it's a case-by-case basis, but if you are having difficulty meeting your living expenses and loan repayments, and it's due to the one income now in the family, certainly get on the front foot and speak to CBA. Banks do not like it when we wait until it's too late and you start missing payments. It's always better, regardless of a pandemic or not, to get on the front foot and try and negotiate a way out. So certainly,
if it was me, I would be down there tomorrow requesting a deferment. You can most definitely apply. So your question was, can you apply? You absolutely can. Will you get it? Well, if it was me, I would be ensuring that there wasn't a whole bunch of money sitting in any of my CBA accounts, i.e. clearing the decks, and I'd maybe wait a couple of days and then go down and say, look, we're doing it tough. You want to be the squeaky wheel, would be my advice. Go hard, go early, right? Someone read that online. Was that from you, Karl, the other day? I think it might have been. I absolutely agree with that sentiment. You're better off in this point of view. Like if this goes on for another 6 months, if you lose your job and you can't get it, you'd much rather to have the money that you were paying in principal interest sitting in your account, other than going through some other process that you need to go through around hardship and so forth with the banks. So yeah, I think I agree with Karl. Sort of, if you're ticking along okay, interest only works. If you've got a speed wobble, you're worried, or you've got some real concerns, I'd be going for a deferment. It's a simpler process as well. That would be my
especially if you can effectively make interest only repayments during that deferred period, which you can, I believe, at CBA. So you can take a 6-month deferment and then still make repayments during that period. That's a win.
Yeah. Okay. Now, sorry, Matthew. He's having issues with sound. Let me just see if I can.
Yeah, apologies. If anyone that's got any sound issues, it might be at your end, it might be at our end. It's difficult to say. We are running this as a live session. So the question was after that was, will the webinar be recorded? It will be, and the sound quality of the recording will be absolutely fine. And Trudy's saying her sound's fine. So it's hard to know, Matthew. It could be at your end or it could be at our end. But yeah, it will be a recorded session, and I'll send it around tomorrow to everyone that booked in for it. Anyway, sorry, apologies there. I struggled with that one. Good. Gold and gold miners have been touted safer bets. However, their prices have been jumping up and down for gold and lower for Australian miners. Let me have a look down here. What's the question? In your view, is it a good and safe investment? All right. So gold has been traditionally a safe haven, but gold traded up with the market. And some were saying that their hypothesis was that was because there was so much uncertainty and a big belief system that the market was going to pull back. But it's traditionally a safer haven than the market. So I don't know where, there are a whole range of things to consider when investing in any of these companies. Going and just buying gold, that's one thing. Going and buying a gold mining company, well, it just depends on the circumstances, their operation, what stage they're at. There's a whole range of things. I'm not sure if I see them as safe havens in every instance, though there are some scenarios where they might be. So it's probably, I'm not someone that does that kind of research, so there would be other people better qualified than us to talk to that one. All right. All right, let's have a look. What else have we got? Okay, that's it for questions. Who's the lowest lender at the moment? Who's the cheapest lender, I should say?
So from a fixed rate perspective, ING's got some pretty low rates in the market, so starting at 209%. You can also get a 2-year fixed rate with one of the majors at 219 with a cashback of $4,000 if your loan amount exceeds $250,000. So there's some pretty incredible fixed and cashback offers in the market. Even the variable rates are drifting pretty low as well. So I'm seeing that in the kind of 2.6 range, depending on loan amount and what we can negotiate, and obviously lenders are always priced for risk. So yeah, so there's some pretty low home loan rates out there. The business rates are they're also pretty competitive now as well, and they're bringing some of these right down, and the lenders are starting to waive merchant fees and do all sorts of things for a period of time.
So, I mean, what is the play here? Is it if you were refinancing, would you be looking at is this a good time to refinance? Is it a good time to go?
Oh, definitely.
Yeah?
Certainly. There's been so much movement in the market in the last, obviously in the last couple of months, but even before that, it's a very competitive space, always has been, but the banks are fighting tooth and nail. All the lenders are fighting tooth and nail for market share, so that puts home loan borrowers in a good position from an ability to negotiate perspective. So if you're getting an existing home loan, certainly go back to your current lender and see what they'll do, and then we can market test that against the market for you.
Okay, so if someone wants some help with this, they come and see you. You can go and speak to their existing lender, try and negotiate the best rate with their existing lender, or refinance them with another. Is that the
correct? Yep.
Yep.
Exactly.
Okay. And you're saying fixed rates as low as 2%?
So 209.
We may as well call it 2. Is there any guidance on where interest rates are going from there that you've read? Do you have an opinion on it? Do you think they're going to zero?
I usually refrain from providing opinion on interest rates, that's for sure. You can read any newspaper once a month to get some talking heads on that one. Look, the banks aren't silly. They don't give away money. So when they're offering you 2.09%, they're obviously forecasting where the market's going. So I always say to my clients that you don't choose a fixed rate based on trying to beat the banks or thinking that's a cracking opportunity. It's got to be about security and comfort. Obviously, historically, it's an extremely low level, and the banks have priced. It's been interesting since the last emergency RBA cut. Only ANZ moved their variable rates. They dropped by a further 0.15%, whereas all of the other banks chose to reduce their fixed rates quite aggressively, which is a reasonably smart play from a I guess protecting their book perspective.
Yeah. Anthony's asked if holding cash term deposits, are they safe with the banks? And do you think that we will see an increase on term deposits? An increase on the rate provided on term deposits, or an increase in the amount of money going into term deposits? I would think,
I wouldn't know. I wouldn't know on either one of those. The government guarantee still applies though, in terms of I think it's 250,000 with the major banks.
Yeah.
So if you've got 250,000 cash with them, that's protected.
Yeah.
You might need to fact check me there on the actual number. I think it's 250,000.
Yeah. All right, we'll fact check you, mate. All right, so and I guess after all of that, right, you go through this process. I mean, the banks. You're saying the banks are fighting for market share at the moment. So if we go in there and say I want to move from Bank of Melbourne over to CBA, they're actually. Is it going to be a nightmare where I'm, every time I've got a question or need to do something, it's going to be sitting on the phone for 5 hours? Or do I just come to you and you do it for me and it's a bit of paperwork?
Of course, I'd prefer it to be the latter. Look, there is still a mountain of paperwork to be completed if you go to a lender, but the goal is to make that process as simple as possible. They have been, it's been interesting. Ross McEwen, the new CEO of NAB, made some comments earlier in the week around, I guess, effectively the major banks, and Shane Elliott backed this up, CEO of ANZ, effectively stating that they're being dragged into the 21st century, kicking and screaming, so to speak. So they've made, throughout this pandemic, they've, in the space of weeks, they've implemented serious compliance and IT changes, allowing things like digital verification of identity and video conferencing for loan meetings and so forth, all in a very short space of time, things that were touted, for years to come. Surprisingly, digital signatures have been accepted for, I think, about 27 years in Australia in law, and they still don't allow that, which is bizarre. But look, I think that they'll, we're going to see some big changes, and the process will speed up. Most of the work I do with my clients is digital in terms of the onboarding and uploading of documents. Most of the statements and everything that's required are extracted directly from bank feeds. So there's not a great deal of running around. It's not like it used to be, where you had to back the truck up with your filing cabinet on it. Yep.
So if so at the moment, a fixed rate, someone who's got $1 million worth of debt can fix in at 2.09. Are they getting any discounts for professionals or bigger amounts or anything like that above and beyond that 2.09?
No, that's pretty solid from a fixed rate perspective. They don't negotiate a great deal on fixed rates. It's on the variable rates they'd be more likely to negotiate.
Okay, beautiful. All right, so well, if anyone is interested in seeing that, so variable at 2.59, and you reckon that's possibly negotiable, I don't know. That seems like an extraordinary good rate. I think interest rates are going to go down. That's my view. But I don't know whether fixed rates will go down. So, and how long can you fix in that at 2.09 for? Is that like a 3-year, 5-year?
That was a 2-year rate.
2-year rate. Yeah. Okay. Fair enough. I'll beat
So the real low fixed rates, that sort of 2 and 3 year space.
Right. Okay. Beautiful. Right. Well, if you'd like Karl's assistance to do all the paperwork and all the heavy lifting and find you the best rate and do all that kind of stuff, type yes into the chat box and he will coordinate. I'll organise, I'll take that as instructions to provide your information across for him to be able to contact you or send you his details. So if anyone would like to get Karl and have him, he's fastidiously works away and is always across everything that's going on in the markets. He's all in a position where he can solve pretty much all the problems that would come at him. So whether it's a more complicated low doc scenario, business loan, or just a normal home loan, he's right across it, got a really good team behind him, and you know, is very, very accommodating, very, very knowledgeable. So if you would like any more information about what he does or you'd like to get in contact with him, just type in yes. You know, I think an extraordinary time that in the markets at the moment, it's not a bad time to be active, up and about. You know, a lot of people are sitting there. Go and see what rate you're paying. A lot of people are paying, you know, into 3.8s, 4% and the like. Someone's asked what the cost for Karl doing this is. Karl, do you want to answer that question?
Certainly. So in almost all circumstances, there's no cost on the residential home loan side. So the lender that you choose usually pays a commission, which is all disclosed and declared up front and explained in detail.
Yep. So if you're in a situation where you're, like many people, paying in the mid to high threes on your home loan at the moment, you could be down 1% off that, massive saving. The thing that we don't like is the paperwork. You can bring Karl in to assist you with that, do the paperwork, and also find you the best rates and a suitable lender for your circumstances, and also be someone that you've got, like I have, where if something happens, you've got someone you can pick up the phone and talk to that can talk you through what's going on. The 2.59 was a variable and the 2.09 was a fixed. Nick, is asking, is that with the big fours?
One's with the big four and the other one was a second tier lender.
Yeah. All right. All right. So what's your view? What's your crystal ball telling you it's going to happen 6 months from now? Is you got a view on what the economy's going to be doing?
Yeah, no, I hate crystal balls, mate. I think, look, it's obviously going to be really tough times ahead. I don't think, I hope that people aren't assuming that businesses are just going to reopen in exactly the same way that they were once before. Some will, of course, but I think we're going to see a big change in the way we work and the way we reopen our businesses and the thinking around the capital we've got behind us and the risk management that we take in our businesses. I think that's what's going to change, and there'll be a lot of people restarting, but in startup mode, effectively in lean startup mode, because they have to. It's the world will be different, and I think it's going to take, without wanting to be too gloomy about it all, I think it's going to take a long time for us to get back to where we were. But I'm not sure. Hopefully I'm wrong.
Anthony's asked if holding bank shares, and maybe include just shares in general, will the bank take that as part of your loan security?
No, they won't. Sorry, Anthony.
All right. We didn't really go through your presentation, Karl, but there's the slide that you...
That's okay. That's fine.
No,
that's fine, mate. It's yeah, it was really just an action plan around what you can do to in these circumstances. You know, as I said, in these uncertain times, it's important to have a bit of a plan of attack, because there's who knows what's ahead and how deep this is going to run. So it's really important to be able to work through you know, all of your options. So obviously the first one, speaking to your bank, broker or lender. So that's just making sure that you're on the front foot. Like we talked about earlier, start a budget. That's an oldie but a goodie. Really, you need to have a hold of your finances. You need to understand where your money's going. There's plenty of software out there. It's never been easier to track expenses, and it's also never been easier to spend money. So getting a hold of that now is critical, and it will allow you to make better financial decisions moving forward once you know what your true expense position is. Number 3 there, so just understanding your equity position. Most lenders will price for risk, so they want to know what risk they're taking by giving you a particular interest rate. So the more you know about that, the better. Any good broker should be able to get you a bank valuation, a full valuation completed up front on your property before you go and negotiate. So that's important to keep in mind. Number 4 there, to utilise offsets and redraws. So that's as we talked about earlier, understand where your money is. You've got money aside. Pat had some suggestions, which I'd encourage you to download this and re-listen to it and potentially enact. So number 5 there, consider reducing your repayments. That sounds like a strange one, but over the years, as interest rates have dropped, most lenders won't automatically reduce your repayments in line with those decreases. So your minimum contracted repayment might actually be a lot lower than what you're paying presently. So reducing that minimum might free up some cash flow. Number 6 there, so negotiating a lower rate, which ties into that knowing your asset value. So going back to your lender and actually requesting a new interest rate based on what they're offering the market. It's very rare that existing customer is paying, after a couple of years is paying what the new to bank customer rate is. Sometimes referred to as a loyalty tax. You don't want to be paying the loyalty tax. A good call script can help with this. So really having your information ready to roll when you have that chat over the phone, because the minute you ask for a discharge form, you should be diverted through to a retention team, and that's when you can have some serious discussions around what the market's doing versus what you're paying presently. And number 7, so consider switching to interest only. As we said earlier, that's sometimes easier said than done, but if it's an investment loan, that's far easier than if it's owner occupied, but it still might provide an appropriate sort of short-term strategy to alleviate that cash flow strain.
I think it's amazing. I'm actually a bit staggered by those rates. I thought I had a really competitive rate on my home loan, but I'm just doing my calculations, based on that, if I refinanced, and I will be talking to my bank again after this session, if I refinanced, it would save me, like, just on interest payments, somewhere around $8,000 a year, right? Which,
I worked through a
5 years, $40,000. Geez.
Sure. I did one today. I worked through a cost benefit analysis for all my clients who were considering switching, and I did one today, which was definitely the exception rather than the rule in terms of the figure that came out at the other end of it. But he was looking at in excess of 80 grand over 5 years. So it was 20 in the first year, and then 16 for the remaining 4 years. So it was pretty big numbers.
Yeah. Well, as you said, batten down the hatches. All these things are really sensible things to do. So if you'd like Karl to give you a hand, you're in a safe pair of hands there. Just type in yes as you bump off this session tonight, and we'll organise. And otherwise, thank you very much for taking the time, Karl, to be with us. Thanks for everyone for joining. I'll flash up Karl's details on the screen there. If you can take those down if you'd like, and reach out to me any time of the day, any day of the week. Karl's there, waiting for your call.
Just one last thing. It's clickbait heaven out there at the minute. So last Tuesday I read 4 different estimates of where the unemployment rate could get to, ranging from 11% to 30% on the same day. So we all know the media loves a negative story, and it's hard not to get caught up in it. But just try and steer clear of it and listen to your advisors, listen to the government. Stay safe, stay home if you can, and that's really all I want to say. But really, thank you for the opportunity to speak to your listeners, Pat, and thank you everyone for listening.